Welcome to RO Academy, and welcome to this presentation on highlight of IFRS 1, first-time adoption of IFRS. This standard aims to ensure that a company's first IFRS financial statements and interim reports are of high quality, transparent, and comparable. IFRS 1 also provides a foundation for future IFRS reporting, helping organizations at a cost that balances with the benefits of enhanced transparency and comparability. The standard guides companies on how to follow a specific sequence when applying IFRS for the first time. It also covers the steps for restating balances from previous GAAP to IFRS, presenting comparative information, and the necessary disclosures to show the effect of adopting IFRS for the first time. IFRS 1 can be challenging for organizations transitioning from local GAAP to IFRS. Some of the main challenges include implementing full retrospective application, handling mandatory and voluntary exemptions, and deciding when to apply fair value as deemed cost. Companies also need to determine the timing of the standard's application and make transition adjustments. Additionally, management faces decisions with varying consequences, which often become apparent only at the end of the adoption process when reports are presented. In the end, we will help you understand how to overcome these challenges. Let's dissect each of the challenges IFRS first-time adopters face as they make the challenging shift from their previous GAAP reporting framework to reporting using international financial reporting standards. One major challenge is the requirement for full retrospective application. To achieve this, all IFRS standards in effect and applicable to the first-time adopter at the time of transition are applied retrospectively, with some minimal exemptions to ensure comparability. Using the full retrospective approach presents challenges, including gathering historical data that might not be readily available and revaluing assets and liabilities. Identifying differences between previous accounting standards and IFRS is essential and often costly, requiring the expertise of valuation professionals. Retrospective application of IFRS can often be challenging due to costs, time requirements, and data limitations. Fortunately, IFRS 1 offers exemptions to ease this process, such as using previous GAAP estimates or choosing not to restate past business combinations. These exemptions can be either mandatory or optional, providing first-time adopters flexibility in their transition. Understanding which exemptions apply can be tricky, as misapplication can result in financial misstatement. In our Arrow Academy online trainings, we discuss such exemptions in detail and with practical examples. For instance, IFRS 1 requires that mandatory exemption for estimates under IFRS to match those made under previous GAAP unless objective evidence indicates that the estimates were incorrect. The reason for making the exception on estimates mandatory is to bar adopters from using the benefit of hindsight to change previous estimates without reason. On the other hand, voluntary exemptions, like the option to avoid restating past business combinations, may ease the transition but introduce complexity in decision-making. Join us in our training to elaborate on such complexities. To weigh the options, determining the best approach for a first-time adopter requires decision-makers to consider factors including availability of historical data and the impact of each exemption on their financial position, as most would affect retained earnings. A widely used voluntary exemption under IFRS 1 is the option to use fair value as deemed cost. Companies can choose to use the fair value of certain assets as a substitute for cost or depreciated cost at the transition date. This option offers both opportunities and challenges. On the one hand, it simplifies reporting and allows companies to use fair value as a surrogate for historical cost. However, it also involves complex asset valuations and requires professional expertise, which can increase both time and cost. Furthermore, decisions made today can have significant impacts on future depreciation and impairment calculations. To explore these opportunities and challenges further, we encourage you to attend our IFRS 13 training. One critical aspect of adopting IFRS is reconciling equity and total comprehensive income between GAAP and IFRS for both the opening balance sheet and subsequent financial periods. The standard requires a first-time adopter to reconcile their previous GAAP financial statements with IFRS, starting with the opening balance sheet and continuing through future reporting periods. The reconciliation must be disclosed, adding complexity as it requires a detailed understanding of both IFRS and the previous GAAP. The challenge lies in identifying all the subsequent periods presented in the first financial statements under IFRS. Deferred taxes under IFRS 1 are challenging. Changes in asset and liability values, especially from the use of fair value as deemed cost or retrospective adjustments, can have significant tax consequences. Calculating deferred taxes based on these new valuations can lead to complex and unexpected tax impacts. IFRS 1 presents several challenges, from full retrospective application to navigating exemptions and managing deferred taxes. Understanding these complexities is the first step towards a smoother transition. With the guidance of IFRS experts at the Aero Academy, you can effectively overcome these hurdles and ensure a successful adoption. Aero Academy offers a range of resources. Visit our website for expert-led webinars and interactive workshops tailored to help you navigate these changes effectively. Register to train with us and subscribe on all our social media platforms to get more insights into IFRS implementation and group reporting. We remain committed to making your group reporting a non-event. Thank you for joining Aero Academy. We value your support.